this webinar. Apologies for the delay. We will start this webinar in a couple of minutes. I'm sure that you are able to hear my voice loud and clear, and you can also see my presentation. If yes, please anyone can say yes on the YouTube channel so that I can start this particular webinar. Okay, very good morning. This is Prathamesh Malia here. I'm an expert in commodities and currency space. I'm a subject matter expertise at Angel Broking Research, and this is the first of a session of commodities on the YouTube live channel. And I am sure that you will find next 1 hour very interesting, because about today it's the very basics of commodities. Because unless you study A, B, C of commodities, you will really not be able to get what is Z of commodities. To start with the webinar, this is the structure of this particular webinar, wherein I am going to talk about 10 basic pointers, starting from types of asset classes, followed by classification of commodities, why commodities are required, exchanges that are required for trading, timings of the commodity exchanges, how to study commodities, participants and products, circuit limits that one needs to know if you are a part of commodity trading, economic indicators, which is a must watch if you are trading commodities, and last but not the least, basics of precious metals and energy markets. To brief you about asset classes as such, I think there are 5 basic types of asset classes, starting with cash, followed by equity, then followed by fixed income, real estate, commodities at last. Just to brief you that commodity is also one of the asset classes that starting from other asset classes, I think from a cash perspective, it is one of the liquid asset classes that one has. The second asset class that one is aware of is equity, wherein ownership of shares is clearly defined as you trade in equities, as you invest in equities. The third asset class that can be defined is in investments in recurring deposits and fixed deposit, which is nothing but a part of fixed income. The fourth asset class would be classified as a real estate, wherein physical position of real estate is what defines the investment in this asset class. And finally, commodities, wherein the ownership of goods starting from gold, silver, copper, crude are the particular asset class that one needs to put their mindset into. So this is a brief about asset class. The key takeaway from this particular slide, and one individual needs to have their eye on, and you really cannot ignore this asset class. In order to put things in perspective, just like you have different sectors in equities, starting from IT, pharma, banking, and a host of sectors in which the n number of stocks are listed. In a similar pattern, commodities can also be classified into 2 sectors. One is non-agriculture commodities, the second is agriculture commodities. Non-agriculture commodities can further be classified into 3 sectors. The first is precious metals, second is base metals, third is energy. Precious metals can further be classified into 2 commodities, which is gold and silver, which is heavily traded not only in the domestic market but also in the international markets. Base metals, wherein 5 commodities are listed in this particular space, which is lead, zinc, copper, aluminum, nickel. In the energy space, you have crude oil and natural gas, 2 components being used for trading as a part of this particular sector. And at last, it is agriculture commodities, which can be classified into oil and oilseeds, cereals and pulses, spices and guar complex. This is just to brief you how commodities are divided. The basic classification would be just in the form of 2 sectors. One thing that needs to be remembered is it is non-agriculture commodities and agriculture commodities. Why commodities? When in comparison to equities, you have almost 7,000 stocks that are listed on the exchange. Vis-a-vis, if you look at commodities, there are 20 liquid commodities that are traded on the exchange. Out of that 20 commodities, 5 commodities are heavily liquid, and it is understood by all, namely gold, silver, copper, crude, nickel, zinc, aluminum are 4 to 5 commodities which are heavily traded in domestic as well as international markets. So in this particular case, out of 7,000 stocks, if you need to shortlist one stock which will give you maximum return, is nothing but a problem of plenty. Vis-a-vis, if you are doing it with commodities, I think it eliminates the option of choice, wherein you have very few commodities to understand, few commodities to trade, few commodities to invest into. Vis-a-vis equities, yes, it is easy to understand, it is easy to trade, you know what to eliminate, what to keep. And in comparison to equities, I think commodities is one of the best asset classes, and there is no scope. Commodities are traded in the international markets, and there is no real globally in the developed markets. It is US, Europe, Japan, China, and even in the domestic markets. The other reason why commodities needs to be understood is from a diversification perspective. Wherein you have all the asset class that I just have commodities as an asset class from a diversification perspective, in order to probably maximize your returns, or the second case would be the hedge against the risks that arise of other asset classes. So these are two main components in order to understand why commodities has to be understood as an asset class. And since this is a global traded commodities, the liquidity that is there in asset classes is ample. Yes, it might not be same in comparison to what is there in equities, since this is a growing market, and and the other benefit of trading of understanding commodities is the existence of the stocks that are listed on the exchange would not have been possible if they do not deal with in the business of commodities. So in crux and in essence, commodities is one of the essential part of any individual, whether it be he may be sitting in any part of the globe. You cannot eliminate commodities, and hence commodities has to be understood in the global context. Just to simplify things for those who are new to commodity markets, commodity exchanges can be classified into two sectors. One is domestic, second is international. As far as domestic markets are concerned, I think there are 5 exchanges that are mainly involved in trading of commodities. The first is MCX, which is Multi Commodity Exchange. The second is National Commodities and Derivatives Exchange, Indian Commodities Exchange, followed by BSE, which is Bombay Stock Exchange, and National Stock Exchange. On the international arena, I think NYMEX, which is New York Mercantile Exchange, followed by Commodities Mercantile Exchange, and which is a part of US Exchange. It is in US, and the last but not the least, it is Shanghai Future Exchange, which is a part of China. So in the entire context, you just cannot eliminate understanding commodities without understanding the exchanges that are involved in it. If you don't know which exchanges trade what commodities, I think understanding commodities and probably getting into a trade or getting into export and import would be a risky proposition affair. But then since it is a commodity which is traded in the global context, I think international exchanges would have a fair bit of presence as well as in the domestic markets. This is one of the important slides that I need to put forth, and you really need to understand that what are the timings of different markets that open and that start according to Indian standard timings and that ends according to Indian standard timings. I think New Zealand is the first markets to start as per Indian standard timings, which is 3:30 a.m. In the morning, while New York Stock Exchange is the last markets to start as per Indian standard timings, which is 8 p.m. In the evening. As you can see, the first which is New Zealand and the last which is New York, the end timing, the start timing is 10:30. The end timing is 10:30 a.m. And the end timing according to Indian standard timing is 2:30 a.m., which clearly indicates that commodities as a market runs 24 hours a day globally, and it is one of the most significant markets to look at. Just to put this in context, if you look at the global map, logically sun rises in the east and sets in the west. According to that context, New Zealand is the first country on the right hand side of the map, which clearly says that is the first market to start. and then followed by Australia, followed by Japan, followed by China, Russia, followed by India, and then Middle East and Europe, and then at last it is United States, Canada, and Brazil. So this is how the starts of market happens across the globe. It has to be understood in the context because commodities as such is a global arena wherein commodities are listed globally, and hence it is essential that you know the timings of commodities that are traded in the global context and according to their particular countries, and hence the value proposition here is that commodity timings of different countries, the start and end timing has to be understood as far as commodity is concerned. The crux of showing you the map is since we have seen the map when we study geography, but then the study of commodities does not really start and does not really end without the understanding of geographical locations of the entire globe, and hence you really need to understand the representation where the continents are, where the countries are, and hence you need to really look at the global map in context of commodities. If you really have knowledge about different countries, their climate, it will probably add a value add to the entire context of commodities, and this will possibly tell you what are the risks involved when you have any positions or trading in commodities. So next time when you visit maps, look at it from a strategic point of view rather than just looking at it as a geographical location. Timings of domestic commodity exchange has to be understood in the context. I think we really need to know what are the timings of domestic exchange. EX are one of the two major exchanges in the domestic arena that has more of liquidity with regards to commodities trading. I think Monday to Friday 9 a.m. to 5 p.m. is for agri-based commodities, while 9 a.m. to 11:30 and 11:50 p.m. for all the other commodities, which starts from precious metals, base metals, and energy. So timings of commodity exchanges in the international arena as well as domestic arena has to be understood if you need to understand this from a commodity perspective. In order to study any asset class, I think it is essential that you study it from two perspectives. One is the fundamental side of it, and the second would be the technical side of it. In order to study any asset class, I think you really need to have a mix of both the study in order to possibly tell you where are the prices headed, what are the risks involved in the entire context, and what are the things that you need to look at if you are trading in commodities. Just to give basic examples, if you are doing a fundamental study, I think demand and supply mismatch is one of the intrinsic things that needs to be understood if you need to understand commodities. The global economic situation is also one of the important context that happens while when you are a part of commodities. Currency movements, because there is a trade and there is a situation of exports and imports involved, fluctuation of currency really puts exporter or importer at risk, and hence currency movements are one of the crucial part of commodities. Geopolitical tensions, since we are talking about different countries involved, the political scenario involved, the existing economic scenario, everything matters as far as commodity pricing is concerned. Last but not the least, the climate of different countries really play a very important role as far as producing of that particular commodity or exporting of that commodity is concerned. As far as technical side of the study is concerned, I think support zones and resistance zone indicators are one of the possible ways of studying commodities. Hence, it is a mix of both. This will make one a well knowledgeable and understandable reader from a commodity perspective. Participants and products in the commodity markets, when compared to equities, if you take position in shares, or you purchase shares or you sell shares, what you receive in is a part of your demat account. But as far as commodity is concerned, I think the asset class entirely is different. The delivery marking happens if you keep your positions open as far as commodity trading is concerned or investing in commodities is concerned. So in that case, there are three participants in this particular market, or possibly say three products that happen. Spot market is one of the essential requirements of this particular asset class. I think commodities as such is physical in nature, and the existence of the spot market is what defines where the futures of this particular commodity are headed. And since we have different tools globally with regards to commodities, options is also one of the important products that is available not only in the domestic exchanges but also in the international exchanges. So to talk about participants and products, I think spot market, futures market and options are one of the three markets that needs to be understood in the context of commodities. This is for a simple understanding of, for those who have basic understanding of commodities and if they want to take positions in commodities. As you can see in this particular chart, the size of the copper, for instance, it's 2500 kgs, which is nothing but 2.5 ton. The price quote that you see on the screen while trading is assuming it is 500 per kg at this point in time. The total size of the contract in this particular case would be around 2500 into 500, which makes the total contract size of around 12,50,000. If you need to trade in commodities, I think 5 to 10% of the contract size is what matters if you need to have exposure of trading one lot in commodities. In this case, 10% of 12,50,000 comes to around 1,25,000. You can calculate this for all other commodities. The crux of the matter is that you need to have 1,25,000 in your account if you need to take position in commodities. Circuit limits in commodity trading, and this is one of the important concepts that has to be understood in any asset class context. Since it is commodity trading, I think the upper limit and the lower limit trading range has to be understood. As far as gold, we are taking an example of gold because this is a commodity which is traded globally, and this is a commodity wherein everybody needs to have it as a part of their portfolio. It has to be understood in the context what are the price limits, whether it goes down or up. The first circuit limit that happens will be at the point of 3%, meaning so assuming that gold price is trading at 50,000, if it goes up or down by 3%, the circuit limit is reached, and the trading is cooled for 10 minutes. Once the 3% limit is taken off, it is further allowed to trade up to 6%. Also, once the 6% mark is also breached, 15 minutes cooling off period is taken, and then the trading resumes, which can further be relaxed up to 9%. Once it reaches the 9% mark upside or downside, I think further there are further relaxation in steps of 3% beyond the maximum permitted limit. However, the regulator has to be informed in this particular case. The important intention of telling you this on this particular slide is commodities have circuit limits upside or downside on a particular day. If it breaches that particular limits, commodity trading is stopped for a particular time frame. However, since we are dealing with international commodities, the reference point happens, what happens in the international market possibly happens in the domestic market as well. Although the regulator is taking necessary steps in order to make domestic exchanges more vibrant in comparison to our domestic spot markets. Economic indicators. This is one of the most important things if you need to understand commodities. I think GDP, which is gross domestic product, is one of the key figures that one has to understand in the context of commodities. I think important developed countries like US, Europe, Japan, GDP is a sum of all the indicators that happen in an economy and represented by a number, and hence any number with regards to GDP from developed countries or developing countries has to be looked as an important number if you are trading in commodities. The second bit of commodity trading or this particular market is the meetings of the central bank. I think the central banks clearly play an important and a keen role in this particular markets. I think it is the policy of central banks, which clearly defines what is the balance that is happening in the global economy. If they sense that the global economy is headed for recession, they will take necessary steps. Hence, the policy of the central bank and their meetings has to be understood in the global context in order to understand where prices are headed for different commodities. While the important indicator that needs to be looked at is consumer confidence from the US. It is a number which represents 70% of the US economy, and since we are talking about commodities, US is one of the important producers and consumers of different commodities produced globally, and hence consumer confidence released from the US plays an important role in this particular market. The next important indicator stands at around non-farm payrolls. It releases on the first Friday of every month. It really tells you about the employment scenario that is happening happening in the US, and how the employment scenario would proceed in the coming months depending on the policy of the central bank. So it is one of the important indicators that needs to be looked at. And yes, in order to have a good understanding of commodities, this is one of the important indicators that needs to be looked at. This is for those who really need to understand gold as a market in terms of size. I think the annual average gold production across the globe is around 4,000 tons, and the prime producers in the entire context, which is represented on the left side of this particular pie chart, China is one of the important producers of gold, followed by Russia, followed by Australia, US, Canada, Peru. Which means if any disturbance happen in any of these countries which produces maximum gold produced globally, I think it really has an impact on price. So this is to be understood from a risk perspective. The right hand side of the pie chart clearly says that whatever gold is produced across the globe, almost 50% of it is consumed in the form of jewelry, while the rest of it goes in the form of central banks wherein they accumulate it as a part of their portfolio from a diversification perspective. While exchange traded funds also have the significant contributions in gold, followed by bar and coin demand, which is also one of the important demand side contributor as far as gold consumption is concerned. The key takeaway from this particular slide is that the size of the gold market on an annual basis is 4,000 tons. China, Russia, US, Australia are of the key producers. The important side of the production and the side of the consumption, almost 50% of the annual supply of gold goes in making of jewelry, and hence gold plays an important role as far as any asset class is concerned. This is just for your information, wherein gold as a natural resource is available across the globe, and this is how all the yellow things say where are the mines that are located as far as gold is concerned, and this is just for the knowledge perspective. If you are in India and if you really want to buy gold, I think there are 3 to 4 basic options. The crux of the matter is, if you are in India, you need to purchase physical gold as a part of your investment. I think most of them does it in the part of jewelry, followed by coins and bars. The second option, since we are millennials and we like to accumulate gold, we like to accumulate gold in the form of digital platforms. I think Google Pay, Paytm and Phone Pay are one of the most best options if you want to accumulate gold over a period of time, and then once you achieve a certain mark, you can take delivery of your gold, and there is no reason to fear for any unauthorized or possibly less quality of gold, because it is certified by MMTC PAMP, which is one of the most important refiner not in India but in the global context. The third option that you have if you are in India is investing in sovereign gold bonds. This is purely a good option for those who wants to remain invested in gold for a longer period of time, because the term of this particular gold bond is 8 years, the lock-in period stands for 5 years, and you get interest if you are invested in sovereign gold bonds. This is one of the best options that an individual has if you want to remain invested in gold from a longer term perspective. Exchange traded funds is an option which is very much common in the international context, but it is not so active and not so much available as far as domestic investors are concerned. The last but not the least, if you really want to take the benefit out of price volatility, futures and options are one of the possible ways you can take the benefit out of price volatility. And hence, these are 4 to 5 ways to invest or trade in gold as far as India is concerned. Again, for those, what is the size of silver market is to put this in context. 27,000 tons is the size of silver market. Peru, China, Russia are one of the key producers of silver, and this has to be understood in a context where any disturbance happen in any of these countries producing silver, it has an impact on price. On the other side, if you are an investor in India who wants to buy silver, there are just two options for investments in silver. I think most of the households purchase silver jewelry, followed by ornaments, and the second best option is to buy coins and bars of silver and possibly sell it once the price reaches your targeted level. That is how you invest in silver in India. Since crude oil is also one of the important commodities in the global context, I have put this in a pie chart representation wherein out of the global oil production, this is on per day basis, it is 100 million barrels per day which is produced globally, out of which OPEC contributes almost 35% of the global oil production. Almost 35 million barrels per day is what OPEC contribute, followed by Russia, which is 12 million barrels per day, followed by US, which is also 12 million barrels per day, and followed by rest of the world, which is almost 40%. Just to put this in context, OPEC, Russia and US almost produces 60% of the entire global oil production that happens per day. In the context, since OPEC is one of the important producers of oil, whatever geopolitical disturbance happen in this particular country, it has an impact on oil. Similarly, Russia is also one of the important oil producers. Any disturbance in this country with regards to production or supply or export really has an impact on oil. Similarly, US is one of the important producers and consumers of oil, and you really cannot ignore this country because everywhere you dig a hole, you can find oil in the US. It is one of the important countries as far as oil is concerned in the global context. Just to give you a perspective that 2020 is almost disturbed by the pandemic that has created that havoc across the globe, and because of which the world GDP growth stands at around minus 4.1% for 2020. While in 2021, I think there are some green shoots of recovery possible in 2021. 4.7% is what you can see in this particular chart, wherein green shoots of recovery is possible in 2021. Again, natural gas is also one of the important commodities that any asset class is concerned. US has ample of natural gas available, and this commodity is used in production of electricity and used for cooling as well as heating purpose. This is a commodity which has a lot of volatility, and this is also one of the important traders' paradise. This commodity has to be understood because electricity is used, electricity is produced by using this commodity, and as you can see, the amount of electricity that is generated in the US almost stands at around 40% by using natural gas, and hence it is one of the important commodities as far as commodity asset as an asset class is concerned, and hence you really cannot ignore this commodity. These are some of the important sites for learning if you really need to further delve further, if you need to understand further more about commodity. These are important sites that you can have your reference points as. Similarly, this is also one of the reference points as far as zinc and aluminum is concerned, And the entire key takeaway from this entire presentation would be from a risk perspective. Since this is a commodity as an asset class, you need to understand which markets start first, which markets ends last, so that you are protected from the gap up and gap downs associated with your exposures. The second key takeaway from this particular presentation would be understanding of global economy. I think the key to understand commodities is the understanding of global economy. If you do not have understanding of global economy, I think the study of this particular markets will go for a toss. Geographical locations also holds the key. Observation of maps are one of the important risk indicators. If you really don't know which are the countries that are strategically located at different parts of the globe, I think understanding commodities would be a difficult proposition. The important thing as far as gold and silver producing countries is concerned, you really need to know who are the gold producers, who are the silver producers, what are the risks, what are the uncertainties with regards to gold production, consumption, climate, and other risk factors associated with it. Crude oil, since it is one of the benchmark of global economy, I think the key ingredient stands for whether the global economy is on track or not is dependent on how crude oil prices are headed. And last but not the least, you have clearly seen in the last slide when the global growth for 2020 has gone for a toss, and most of the global economy are in a state of recession. I hope that 2021 would be period of growth, and that is where the study of commodities as an asset class being very important. Thank you very much for listening to me with patience. If you really have any questions, we can take this up. If you have any questions, we can you can put this on a chat, and we can answer your questions. Oh, thank you very much for your participation. We will have a few more sessions on commodities in the next possible time frames, and we will intimate you as and when we are ready with this commodity. Thank you very much for your patience.